Let's talk about a tax that's been quietly sneaking up on more and more people every single year. It's called the Net Investment Income Tax, or the NIIT. It's this 3.8% surtax that, was originally aimed at the highest earners, but thanks to inflation, it's now catching a much wider net of people. So today, we're going to do a full forensic audit, see exactly how this tax works, and more importantly, how you can legally and strategically deal with it. So get this, in 2021, 7.3 million taxpayers got hit with this tax. Now, that is more than double the number from back in 2013. So what gives? Did millions of people just suddenly get super rich overnight? Well, no. The real answer isn't in their income, but in a kind of a flaw that's baked right into the tax code itself. And the heart of the problem is right here on this chart. The income thresholds for this tax, they're basically frozen in time. They don't adjust for inflation at all. This is a perfect example of what economists call fiscal drag, where inflation just silently pushes more and more people into higher tax brackets, even when their actual purchasing power hasn't gone up. Okay, so here's our game plan for this explainer. We're going to start by looking at this inflationary dragnet itself. Then we'll dissect the anatomy of the tax, piece by piece. After that, we'll uncover a really critical distinction in how income is defined. And then, the fun part, we'll get into the strategies to lower your bill and finish up with how you can protect your portfolio. First up, the inflationary dragnet. Let's really get into how a tax that was designed for the wealthy started to creep its way into the middle class. So the NIIT was born back in 2010 to help fund the Affordable Care Act. But when it kicked in for real in 2013, its income thresholds were set in stone. $200,000 for singles, $250,000 for married couples. And because they've never been adjusted, simple cost of living raises and just normal investment growth are pushing more and more of us over that line every single year. In fact, by 2026, that original threshold will have lost nearly half its value. Which brings us right to Section 2, the anatomy of the 3.8% tax. To really counter this thing effectively, we first have to understand exactly how it's calculated. Know your enemy, right? So the crucial thing to understand is that this tax is levied on something very specific called net investment income, or NII. The easiest way to think about this is it's the passive income you earn from your assets, things like interest, dividends, and capital gains when you sell stocks. Now, what's really fascinating here is the clear dividing line. On the left, you see what's in. The usual suspects like interest and dividends. But the really critical information, the stuff our strategies are built on, is on the right. What's out? Your wages are out. Social Security is out. And most importantly for planning, distributions from retirement accounts like your 401k or IRA, they're safe. They don't count. So the calculation itself, it follows this specific kind of quirky lesser of logic. The IRS looks at two numbers. First, your total net investment income. And second, how much your overall income, what they call your modified adjusted gross income, or MAGI, is over that frozen threshold. The 3.8% tax then applies to whichever of those two numbers is the smaller one. Let's make that real with a quick example. Okay, imagine you have $50,000 in investment income, but your total income is just $10,000 over the threshold. Well, you don't pay the tax on the full $50,000. You only pay it on the $10,000 overage. This is so important because it means it's not a cliff you fall off, it's a ramp. And that means every single dollar you can reduce your income by really matters. And this brings us to what I think is the most important part of our forensic audit, the MAGI distinction. This is a little nuance deep in the tax code that a ton of people miss, and it can easily become a hidden trap, especially for retirees. So let me just pose a question here. When the government says modified adjusted gross income, does it always mean the exact same thing? Well, the answer, maybe surprisingly, is no, it doesn't. And right there, that's where the opportunity is. This is it. This is the key. The tax code actually has different definitions of MAGI depending on what tax you're talking about. For most things, they're the same. But just look at that bottom row. Tax-exempt municipal bond interest. For this 3.8% NIIT, it's completely invisible. They pretend it doesn't exist. But for calculating Medicare surcharges, oh, it definitely counts. This single difference is a massive strategic advantage for us. So let me just state this plainly because it's so important. Municipal bond interest is a sanctuary asset. It does not count toward the income threshold that triggers this 3.8% surtax. And that one fact is the cornerstone of our defense strategy. Which, of course, brings us to our playbook, Section 4, Strategies to Lower Your Bill.
Now that we know how the tax is built, and more importantly, where its weaknesses are, we can start planning our countermoves.
All right, strategy number 1 is what we call the sanctuary asset shift. It's simple. By shifting some assets from regular taxable bonds into those invisible municipal bonds, you directly lower the MAGI that this NIIT calculation even sees. It is a clean, dollar-for-dollar reduction of your taxable footprint. Strategy 2 is all about income smoothing. So let's say you sell a rental property or maybe a business, and you've got this huge capital gain. Instead of taking all that cash in 1 year and just blowing past the income threshold, you can use something called an installment sale to spread that gain out over several years. Just like this chart shows, you can keep your annual income under the line and potentially avoid the tax on the whole thing.
And don't forget, your retirement accounts are incredibly powerful tools here. You can play defense by maxing out your pre-tax contributions to a 401k, which lowers your MAGI right now. Or you can play offense with a Roth conversion. Now, yeah, that move might increase your income in the short term, but every single qualified dollar you pull from that Roth in retirement is completely tax-free and totally invisible to the NIIT calculation.
And finally, here's a truly forensic strategy that, honestly, a lot of tax preparers even miss. Form 8960 actually lets you deduct the portion of your state and local income taxes that are directly tied to your investment income. So for folks in high tax states, carefully calculating this ratio can create a significant and perfectly legal deduction against your investment income.
So with all these strategies in our playbook, let's just crystallize the key takeaways for protecting your portfolio from this stealth tax.
Okay, if you only remember 3 things, make it these. First, the NIIT thresholds are frozen, which means inflation is your silent enemy, always pushing you closer to that line. Second, not all MAGI is created equal. That little difference with municipal bond interest, that's your single biggest opportunity. And third, you are not powerless here. Using these strategic tools, you can seriously reduce or maybe even completely eliminate this tax.
And that really leaves us with one final thought. The NIIT is a masterclass in how fiscal drag works, a tax that grows by stealth without any new laws being passed. So, the question we should all be asking ourselves is this. In a world of frozen thresholds, what other silent taxes are hiding in your portfolio right now?